What if I told you there's a trading strategy so powerful, it feels like having a cheat code for the markets? A strategy that's helped me consistently find high probability setups year after year. Sounds too good to be true? Stick around, because today I'm breaking down the ICT unicorn model, a game changer for traders who want to stack the odds in their favor. I've been trading for over 3 years now, and let me tell you, it hasn't always been smooth sailing. I've had my fair share of losses, late nights, and moments of doubt. But once I discovered the unicorn model, everything changed. It became my go-to framework for identifying high win rate setups, and I've been refining it ever since. This isn't just another strategy, it's the backbone of my trading success. In this video, I'm going to show you step by step how the ICT unicorn model works. You'll learn how to spot key levels, time your entries like a pro, and execute your trades with precision. By the end of this, you'll have a clear, actionable blueprint to start applying this model in your own trading. Here's what we'll cover. First, I'll explain the core concepts of the unicorn model and why it's so effective. Then I'll walk you through real chart examples to show you how I use it in live markets. Finally, I'll share some pro tips to help you avoid common mistakes and maximize your results. If you're ready to take your trading to the next level, this video is for you. Trust me, you don't want to miss the insights I'm sharing, especially the one golden rule that makes all the difference. So grab a notebook, hit that like button, and let's dive in. So, what exactly is the unicorn model? It's a high probability trading strategy that brings together 3 game-changing ICT concepts: breakers, fair value gaps, and time. When these elements align, they create a setup so rare and powerful, it's like finding a needle in a haystack. But here's the good news. You don't need to be a trading expert to understand it. I'm going to walk you through each piece, step by step, so you can see exactly how it works and why it's so effective. Let's get straight to the heart of trading the unicorn model. To really nail this, you need to understand how the market reverses. And here's the thing, it only does so in 2 ways: breaker swings and failure swings. These are the market's signature moves, and once you recognize them, you'll start seeing opportunities where others see chaos. Breaker swings happen when the market grabs liquidity before reversing, often by sweeping a swing high or low to catch traders off guard. It's like the market is setting a trap, and then boom, it reverses. On the flip side, failure swings occur when the market tries to grab liquidity but fails, leaving behind what we call mitigation blocks. These blocks are like breadcrumbs, showing you where the market might head next. Here's how it works in action. Imagine a bullish breaker. The market drops below an old low, making everyone think the trend is bearish. But just when it seems like the downtrend is in control, the market reverses, climbs above the high that followed that low, and uses that high as support. This is your signal that the market could be gearing up for a move higher. Now, picture a bearish breaker. The market rallies above an old high, looking strong and bullish. But then, out of nowhere, it reverses, drops below the low that followed that high, and uses that low as resistance. This sets the stage for a potential move lower. Now, let's dive into fair value gaps, or FVGs, one of the most powerful tools you can use to spot trading opportunities. Picture this, a 3-candle pattern where the wicks of the first and third candles don't overlap, leaving a clear gap in price. This gap, or imbalance, is like a vacuum in the market, and more often than not, the price will return to fill it. That's the essence of a fair value gap. There are 2 types of FVGs, bullish and bearish. A bullish FVG, also known as a buy-side imbalance or sell-side inefficiency, happens when the market rockets upwards so quickly that sellers don't get a fair chance to participate. This creates a gap, and because the market loves balance, it often revisits that area to fill the void. On the flip side, a bearish FVG, or sell-side imbalance and buy-side inefficiency, occurs when the market plunges so fast that buyers are left scrambling. This creates a gap, and just like with the bullish FVG, the price tends to return to fill it. Think of fair value gaps as magnets. They pull the price back to areas of imbalance, giving you a chance to enter trades at fair value. But here's where it gets even better. When you combine FVGs with key levels on higher time frames, you start to see the bigger picture. These gaps help confirm your bias and highlight high probability setups. Now, let's talk about the secret sauce that ties everything together. Timing isn't just important in trading, it's everything. The unicorn model thrives during high volatility periods, and that's when you need to be locked in and ready to act. But here's the thing, it's not just about being awake, it's about being in the right market at the exact right moment. If you're trading Forex pairs, your sweet spot is the London session. Think 2 a.m. to 5 a.m. Eastern Standard Time. This is when the market comes alive, and you'll see the kind of explosive price action the unicorn model is built to exploit. For indices, shift your focus to the New York session. The magic happens between 8 a.m. and 12 p.m. Eastern Standard Time. This is when the big institutional players step in, and the market moves with conviction. But here's the pro tip. Don't just rely on the clock. You've got to keep an eye on the economic calendar too, which you can find on the Trading Tiger website under their tools section. They help you stay ahead of the curve and align your trades with the kill zones, those high-impact times when the market is most likely to make big moves. By combining the right timing with the unicorn model, you're not just trading, you're strategically positioning yourself to catch the best opportunities. Alright, let's put the unicorn model into action and see how it all comes together in real-time trading. Here's how you can spot a unicorn setup and make it work for you. Start by identifying the draw of liquidity. This means checking the higher time frame bias to pinpoint key levels where the market is likely to react. These levels could be external range liquidity, like swing highs or lows, or internal range liquidity, such as bullish or bearish fair value gaps that align with your overall bias. This step is crucial because it confirms the direction you should be trading. Once you've got that, drop down to a lower time frame to look for the setup forming. Next, timing is everything. Make sure the setup forms during a kill zone, those high-impact periods when the market is most active and volatile. Watch for the overlap between the breaker and the fair value gap. For a bullish setup, you want to see displacement above the breaker high. For a bearish setup, look for displacement below the breaker low. This is the moment the setup comes to life, and your opportunity becomes crystal clear. Once all these pieces align, it's time to act. For a bullish setup, enter your trade at the breaker high. For a bearish setup, enter at the breaker low. Place your stop loss just below the breaker low if you're going bullish, or above the breaker high if you're going bearish. Then aim for a 2-hour target. It's a clean, rules-based process that takes the guesswork out of trading. By following these steps, you're not just trading, you're executing a proven strategy that lets the setup do the heavy lifting. Now that you know the rules, let's see this strategy come to life. I'm about to walk you through real examples where everything clicks into place, and you'll see exactly how to spot these setups in action. Let's dive into this first example on the 4-hour chart for the Nasdaq. We're approaching an all-time high, which is our external range liquidity. Along the way, the market has also created a fair value gap, a key area we'll likely revisit before pushing the price toward that high. With this bias and context in place, let's drop down to the 15-minute chart to see how this plays out. As we move the price forward, we see it wick through the 4-hour fair value gap. However, there's a breaker block here without an overlapping fair value gap, so no unicorn setup forms just yet. No problem, let's keep watching. Price continues to move, creating new buy-side and sell-side liquidity near our previous PD arrays. Eventually, the market takes out the sell-side liquidity, and now we're anticipating a close above the breaker block with displacement and an overlapping fair value gap. And there it is. Price delivers exactly what we're looking for, a breaker block overlapping with multiple fair value gaps, forming a clean unicorn setup. This is our signal to enter. I'll place a limit order at the top of the breaker block, with a stop loss just below it, giving it a little breathing room. For the target, we're aiming for a 1 to 2 risk-to-reward ratio, which is more than enough to lock in consistent profits. The trade triggers almost immediately. And just like that, we hit a clean 2-hour profit. Before moving forward, let me ask you something. Are you tired of inconsistent trading results? Feeling like the markets are just one big guessing game? What if I told you the Trading Titan blueprint could change all that? This is your chance to get the exact strategies I use, tools that make decision-making easy, and an AI indicator that literally shows trades right on your TradingD chart. Plus, you'll get access to premium signals directly from us. These benefits have already helped over 200 people get funded. Imagine what they could do for you, and if you ever feel stuck, I've got your back. You'll also join a community of traders who went from struggling to passing funding challenges in just 6 weeks. But here's the thing, spots are limited, and this won't be open forever. If you're ready to finally take control of your trading and start winning, apply now before it's too late. Now, let's shift to gold on the daily chart. Here, we have external range liquidity as our potential target, along with a fair value gap that's already been tapped. We've also taken out buy-side liquidity, turning it into external range liquidity. while the fair value gap acts as our internal range liquidity. Remember, the market moves from ERL to IRL and back, so we're looking for a price to target that external range liquidity next. To figure out how price will get there, we analyze the PD arrays. Since we're already in the fair value gap, the closest PD array likely to push price toward our target is the previous day's low. Let's drop down to the 15-minute chart to see what's happening. At first, there's nothing actionable, so we'll skip ahead to the next day. Price takes out the previous day's low, and now there's no PD array opposing our trade. It's almost 8 a.m., the start of the New York session and one of our kill zones. Price creates a fair value gap, which gets tapped and respected, so we're expecting a similar move again. As we play price forward, another fair value gap forms, overlapping with an order block. This creates a high probability unicorn setup. I'll place a limit order at the top of the fair value gap, with a stop loss below the low of the overlap, giving it some breathing room. For the target, you could aim for the external range liquidity, but I recommend sticking to a fixed 1 to 2 risk to reward ratio for consistency. I placed the trade, risking 1%, and we're triggered into the trade within the next candle. A few candles later, we smash our take profit target. You could even trail your stop loss for bigger gains if you wanted. These setups are mechanical, repeatable, and require zero guesswork. Once you see it in action, you'll realize how powerful this strategy can be. Here's the strategy in a nutshell. Start by finding the higher time frame bias using breaker blocks and fair value gaps. Then, line up your trades with kill zones and keep an eye on the economic calendar for timing. Enter at the breaker high or low, set your stop at the opposite end, and aim for a 2R target. This works on all assets, but I've found it especially powerful on indices like the NASDAQ and S&P 500, and metals like gold and silver. Here's a golden tip: always backtest to see what fits your style, and don't forget to tweak your approach as you go. If this high win rate ICT unicorn strategy helped you, hit that like button. When we hit 220 likes, I'll drop a full backtesting video breaking down exactly how this setup performs over time. The free PDF guide for this strategy is waiting for you on my Telegram channel. Grab it now and start using this powerful setup today. If you're serious about fast-tracking your trading success, join the Trading Titan Blueprint to get funded within 6 weeks before it's gone forever. This is your chance to turn your skills into real results. All links will be in the description below. Stay sharp, stay hungry, and let's keep stacking those wins. See you in the next one.